the biggest banking bailout that you're not hearing about. I was talking about this, gosh, 10 years ago, more than 10 years ago. Um, the biggest banking bailout's been 0% interest rates. This has been theft. This has been theft on the working and middle class, and no one talks about it. So it's been, and we, and the fact is that we're still recovering from the financial crisis. There's no doubt about that. And think about it. Nobody went to jail for the fraud in the financial crisis, and nobody was even investigated. No one was even investigated. Think about that. It's pretty disgusting. Let me just tell you all something, by the way, FYI, okay? It's a very important point that you're not going to hear anywhere else, guaranteed. How do I know that? Because, folks, I've learned throughout the years the things that I talk about aren't mentioned anywhere else. I knew that the financial industry, and if the financial industry is filled with knuckleheads, ask yourself what the financial media is, and then ask yourself what YouTube is. Right? You got YouTube. Bill Ackman said that World War III is coming. Like these guys, they actually follow like Bill Ackman and Ray Dalio and think that they're like God. I mean, these guys, they don't know what's going on. It's like, okay, whatever, But anyway, I realized early on in my career on Wall Street that I proved, and I wrote about this. And since that, it's been more than 20 years since I realized the market inefficiency hypothesis is complete garbage. It's complete rubbish. Yet it's accepted as law in every business school, every business book, every investment book. It's complete rubbish. Eventually, it will be modified. I think it's been modified over and over. Eventually, it'll be modified. They'll kind of try and work it into where, the guy doesn't get, where he's not looking like a monkey, because that's what he is. The guy, what is it, Mikhail? It's a bunch of nonsense. It's not true. Okay, it's a monkey theory. I could go over why, I'm not going to, but I realized that early on in my career. And then you know what else I realized to make me understand that there's a bunch of idiots in the investment and business world who go into those areas, especially investment. You know what else maybe when let me ask you all a question. What's the measure of investment risk? Anyone? Anybody know the measure of investment risk? Come on, everybody knows this. Come on, you all know this. Okay, let me be specific. What's the measure of investment risk for a stock? Beta, right? The beta, right? Exactly, beta. Okay. Beta, as you all know, is relative to what? What has a beta of 1? The index. It's all relative to the S&P index, right? So the beta, if it's -1, if a stock has a beta of -1, it means it moves 100% correlation negative to the S&P. So for instance, gold historically is kind of a good asset for inverse correlation with the stock market. So, I don't know. It's typically, 0.6, 0.7, something like that, maybe 0.8 at certain times. And that's for several reasons. I'm not going to talk about that. It's a negative correlation to the stock market, but it's only short term, typically, by the way. Okay, that is considered investment risk, is it not? Yes, no. But what is beta? Is beta not volatility? Is beta not price volatility? Right? It's measuring the price movement relative to the price movement of the S&P 500 over a specified period of time, right? Correct? Okay. So let me ask you a question. And by the way, this is the securities industry and the securities in the business world as well. If you look at it, investment books, and this is legal. This is legal. So if someone puts you in stocks that have a beta of 2 or 2.5, that's considered extremely risky, right? It's considered extremely risky. But is it really? It's volatility. It's only risky if you're an elderly individual. For me, when I look at risk, I look at, for instance, when I focus on distressed securities analysis, I don't I don't even fucking look at beta. I look at the fundamentals. I look at the management. I look at the actual fundamental picture. Because to me, investment risk is about the risk of bankruptcy, right? Now, if you're older, high volatility stocks can be really bad, right? But if you're younger, high beta is not risky necessarily, right? It's just price volatility. In fact, and I wrote this in one of my books, I've written this discussion that probably no one's ever written before, right? Ask yourself why. I made this, I continued the explanation, for instance. Which is riskier? Large cap stocks, mid cap stocks, small cap stocks? Which is riskier? Exactly, small caps. Why are small caps risky? By the way, how many of these YouTube stock gurus do you think even know this basic information? They're learning now because there's lurkers. They don't know any of this stuff. Don't you think they should be teaching this stuff? No. Maybe you can get a course. They'll probably copy what I have to say and sell it as a course for $5,000. Well, pink sheets are, that's kind of a different, that's actually micro cap usually, not always, but I mean, pink sheet stocks are a completely different category, um, because anyway, a lot of the pink sheet stocks are garbage. A lot of them are, they're delisted, um, over the counter. Anyway, so here's the deal: small caps are riskier. They have higher volatility. They have higher betas, right? That's why they're considered riskier because their betas are higher. Their price swings are greater. Why are their price swings greater? For many reasons. Typically because they're newer companies. Not always. There are some older companies that are small caps, but there's other reasons which none of the numbskulls, none of the knuckleheads on YouTube know about, and it has to do with Wall Street coverage. If you don't have Wall Street coverage, that's a big risk. Okay, but let's just assume here, for simplicity, that we're talking about small caps that are newer companies. They're newer companies, therefore, their business, their cash flows, and their earnings, if they have any, are going to be less certain, right? They're going to be less certain. So you're going to have a larger price swings based upon their business, right? Also, their predictability, their ability, management's ability to, uh, to meet estimates. It's much more difficult when you're a newer company, right? Smaller cap. So therefore, the price is going to be all over the place, right? But just remember, Microsoft was once a small cap. Nvidia was once a small cap. Were they risky as small caps? Well, if you ask the SEC, if you ask FINRA, if you ask a full service brokerage firm, they'll say yes. The deal is though, is that what if you're particularly skilled and you can spot great companies early on? I was recommending Nvidia in 2001, by the way. Okay. Always. And I was always bearish on Intel because I knew the story. I knew they had been cheating AMD for years. I put AMD and Intel, or AMD and NVIDIA on my research recommended list on the first issue, and they stayed on there. 2009, May. My point is that if you're able, and maybe you get lucky, right? If you're somehow able to pick a winner early on, and most people that do that, they get lucky or they forget about the stock. Because it's very difficult to do that and keep following the stock because there's so many challenges. I can tell you one stock for me that I never had, well, actually two stocks I never had a doubt about, and we're talking one is 20 years and the other is about 50, close to 50, yeah, about 15 years. The other is NVIDIA. Never had a doubt because the management has always done very well. Always. It's not about discounted cash flow and all this bullshit. It's about understanding the company, understanding the market, understanding the strategy, the business model, understanding how the management responds to competitive threats. You see, that's the key. But my point is that, I could argue that, hey, you know what? NVIDIA back in 2008 wasn't really that risky, right? But actually, it's risky. It's officially considered risky back then, and probably even now. I haven't looked at the beta. Why? Because of the beta. But what's that have to do with the business? Sometimes the beta is correlated to instability in the business. But is it understandable? Right? Is that beta, the high volatility in the stock price, due to the management screwing up? Or is it an inherent attribute of that company's market, of the dynamics of that company and the market that that competes in? You understand? So it's kind of a higher level argument. I don't think it's that high level though. So I mean, beta isn't really investment risk. It's actually liquidity risk, right? It's liquidity risk, liquidity. So if you're stuck in a stock that has a high beta, it's only a problem if your investment horizon, the duration for which you are invested, is short. Because if you're stuck in a stock that collapses, it's really volatile, it was considered risky, and you're only going to be, you need to harvest those funds within the next 3 years, that's a problem. It's risky, right? But meanwhile, your friend, he's going to be an investor for the next 20 years. So he can endure the downturn. It's just price volatility for him. You see? But for the older investor, it's a risk. It's a liquidity risk because if something is illiquid, it means that you can't sell it for what it's worth. You either take a loss because the price is down, or there's not enough demand to buy it at the price that you want. That's when something becomes illiquid. And that's, by the way, what the Fed prevented during the pandemic lockdown with all those different policies and plans and things that it launched. It wanted to avoid a liquidity crisis, which could have caused solvency issues. It could have caused bankruptcies. FYI. Everybody understand that? The sad thing is that this, what I just explained, is very important to understand for if you want to become a serious investor. But the vast majority of people aren't interested in hearing this. That's the sad reality. And that's why they'll never have a chance at becoming good investors. See? Right?